Yeah. Well, there's been a lot of talk lately about the metals market and crypto hitting a wall all at once, and whether what you're seeing right now is a simple pullback or the start of something much bigger. So, in this video, we're going to separate fact from fiction, and you are going to walk away feeling a lot smarter and a lot more confident about what you're looking at on your screen. It's Friday, February 13th. Something broke, maybe. Or it could be the most boring explanation in finance. Leverage got flushed, liquidity thinned out, and when everyone tried to exit the door got smaller. And I'm not saying that to be cute. I mean that literally. If you've ever been in an airport, when a flight gets canceled and suddenly one gate becomes the gate for three flights, you know what happens. The line doesn't just get longer, the whole system gets weird. People can't hear. People start guessing. Somebody yells that the plane left, and then everyone reacts to the yelling, not the facts. That's what thin liquidity feels like in a market. And here's the sneaky part. When liquidity gets thin, the chart can look like it's telling you a story about the economy when it's really telling you a story about order flow. Think about it like this. If you're at a farmer's market and there are 10 apple sellers, you can bargain. Prices, clears throat, stay pretty stable. But if 9 of those sellers pack up early and now there's one table left, the price of apples can jump around wildly. Not because apples became rare on planet Earth, because the marketplace got smaller. That's why a sudden dump doesn't automatically mean fundamentals changed. It might mean the marketplace got temporarily skinny. And that leads to the next misunderstanding. People assume a big red candle equals everyone sold. Not necessarily. Sometimes it's just a small number of forced sellers hitting a thin book, and the price has to travel farther to find a buyer. Now, in a minute, I'm going to show you the one signal I watch to separate a real trend change from a temporary flush. But first, we have to deal with the way people talk about silver. Silver is not just another metal. It has this split personality, part monetary hedge, part industrial input. So when fear hits, it can trade like a risk asset. When inflation hits, it can trade like a hedge. When manufacturing demand hits, it can trade like a commodity. And when the dollar rips higher for a week, it can trade like an object being priced in a stronger measuring stick. So if you're trying to explain every move with one explanation, manipulation, shorts, central banks, retail demand, you're going to keep getting whiplash. The move we just saw could have been a mix of all of it. And if that sounds unsatisfying, good. Reality usually is. Now, let's talk about that signal I mentioned. It's not some secret indicator. It's the spread. When the paper price falls and the physical market immediately offers you the same metal for roughly the same premium, that tells you one thing. But when the paper price falls and physical premiums either widen or stay stubborn, that tells you something else. It means the supply chain is not behaving like the chart suggests. And based on recent market commentary, that's exactly what's been happening in pockets of the market. Paper price swinging hard while physical availability and pricing behaved like it was trying to hold the line. That's not a guarantee of anything, but it's a clue. A clue that the move may be more about paper positioning than physical overflow. And that's why if you're buying physical, you don't just stare at spot. You watch inventory, shipping times, and the bid-ask that dealers are actually willing to print. Okay, now let's go back to volatility for a second because I want to clear up one more thing. People keep saying the VIX is only in the low 20s. That's nothing. Wake me up when it's at a crisis level. That's a cute slogan, but it's also a trap. Because volatility is not an on-off switch. It's a regime. And the important part isn't just the level, it's the speed. If a fear gauge goes from calm to tense quickly, even if it's not at historic extremes, that speed can still create forced behavior across portfolios. It can trigger risk models. It can trigger hedging. It can trigger sell what you can moments. And those moments can hit silver and Bitcoin, even if the headline is about stocks. So the question isn't, is the VIX at some magic number? The question is, are risk managers tightening a leash? And if they are, you feel it everywhere. Now, speaking of everywhere, let's address that few trillion line you've probably heard. When you get a synchronized sell-off across big asset classes, market value can evaporate fast, not because all the wealth literally disappeared, but because the marginal price changed. And that matters psychologically because people feel poorer and they act defensive, and that can become self-fulfilling for a while. But this is also where the skeptical voice matters. A lot of the loudest commentary right now is designed to push you into a binary mindset. Either buy everything because the system is ending, or sell everything because the bubble popped. Those are the two emotional products being sold to you, and most people buy one of them. So, here's my counterpoint. It's possible for a market to have a violent flush and still be in a longer-term bull trend. It's also possible for a market to bounce hard and still be in a longer-term topping process. Both can be true. That's why you don't anchor on one day. You anchor on your process. Now, the second big claim is about volatility. Volatility is skyrocketing. Okay? Sometimes, yes. But you have to be careful about what volatility we're even talking about, because one of the most common mistakes I see is people mixing up different thermometers and acting surprised when the readings don't match. The VIX is a volatility gauge tied to broad equities, and it did lift into the low 20s during the shakeout. But metals have their own implied volatility, and crypto has its own flavor of volatility, and those can move differently sometimes in the opposite direction. So you can have the broad market fear gauge climbing, while the expected move in a specific commodity is actually narrowing, because traders already paid up for protection earlier, and now they're unwinding it. In other words, you can have a storm outside while the weather inside your house is calming down because you already boarded the windows yesterday. And that's why you saw people arguing online like volatility is exploding, and then someone else saying, no, it's decreasing. They might both be right. They're just looking at different dashboards. Now, here's where it gets interesting, because this is the part most people skip. The paper price and the physical price don't always behave like twins. Sometimes they do, but when the market gets jumpy, they start acting like cousins who don't talk. Based on recently published dealer notes and price sheets, spreads widened fast and premiums in some regions stayed sticky even while the paper price was swinging around. And if you've never experienced that, it can mess with your head because you're looking at one screen saying down, and then you call a dealer and the quote doesn't feel down at all. So people say, wait, is it cheaper to sell than to buy? And sometimes for certain products at certain moments, it can feel that way. Not because the metal became magical, but because the bid and the ask are doing a little dance in a stressed market. Let me explain it in plain English. When volatility spikes, market makers protect themselves. Dealers protect themselves. Everyone widens the lane. So your sell quote is based on what they can hedge, what they can replace inventory for, and how fast they think prices might whip the other way. And your buy quote is based on the same thing, plus shipping, plus restocking risk, plus the fact that if the crowd is panicking into physical, the crowd doesn't care about spot. The crowd cares about, do you have it? And that's why a sell price can look harsh and a buy price can look expensive at the exact same time. It's not proof that demand is fake, and it's not proof that demand is infinite. It's proof that the market is nervous. Also, notice how the rumor always arrives with the same emotional packaging. It's never, hey, there might be accounting questions. It's always the most extreme version, because extreme versions travel farther. But let's talk about what a real audit would actually mean, because this is where the conversation usually gets sloppy. A real audit isn't a politician walking through a vault for a photo op. A real audit is a boring, grinding process, cataloging bars, verifying serial numbers, weighing, assaying, reconciling records, and then disclosing what's encumbered and what isn't. And that last part, encumbrances, is where people's imaginations run wild. Leases, swaps, pledges, all the stuff that makes the story complicated. Now, could there be unusual arrangements around reserves? Sure. Governments do complicated things, but complicated is not the same as gone. And here's why I'm pushing this point. If you make your decisions based on the most extreme rumor, you'll constantly live in emergency mode. And emergency mode leads to sloppy choices. So if you care about this topic, you should actually want the boring answer, whatever it is, because boring answers are actionable. Now, I also want to point out something historical that gets forgotten. Governments have done partial verifications and inspections at different times, and officials have publicly described reserves, but critics argue those steps weren't comprehensive or independent enough. That nuance matters because not enough for critics can be true, while empty can still be false. Okay, keep that nuance in your pocket as we move on, because the next rumor works the same way. It takes a kernel of truth and turns it into a movie trailer. Now, the third big claim is the one that gets people emotional. Fort Knox has no gold. Let's handle this carefully. There is a difference between there hasn't been a modern, comprehensive, independent audit the way some people want, and there is zero gold. Those are not the same sentence. And right now, what's real is the first part. There have been renewed calls in Congress for more transparency and a more comprehensive audit framework. That alone tells you something important. This topic is politically useful and it's psychologically powerful, but it does not by itself prove the most extreme rumor. So here's the question I want you to answer in the comments, and be honest. Do you think the truth is all there, none there, or somewhere in between? Because that middle option is the one nobody wants to talk about, and it's usually where reality lives. Now, while everyone is staring at that rumor, another story slid under the radar. States exploring ways to treat gold and silver like money again, at least inside their own boundaries. And I'm not talking about a movie plot. Texas has already passed legislation around recognizing gold and silver for certain forms of payment and building out a system connected to its bullion depository over time. And to be clear, this isn't just one state talking out loud. Over the past few years, you've seen a slow drip of bills and proposals across multiple states that try to treat gold and silver as money for certain purposes. Tax treatment, payments, depository systems, even exploring digital rails that represent metal held in custody. Most of these efforts are small. Some are symbolic, a few are operational, but the direction matters because whether you love it or hate it, it's a sign that trust is being negotiated in public. And that's the key word, trust. When people trust the currency, they don't think about alternatives. When they stop trusting the currency, they start looking for off-ramps. Sometimes that off-ramp is Bitcoin. Sometimes it's gold. Sometimes it's simply moving cash into shorter-term instruments. Sometimes it's just buying more inventory for their business because they'd rather hold stuff than hold dollars. And when enough people search for off-ramps at the same time, you get the kind of day we just saw. Now, here's another detail that doesn't get enough attention. Even if a state creates a framework, you still have a practical question. What is the unit you're actually using? A coin, a bar, a digital credit, a receipt? Because the moment you introduce a receipt, you've reintroduced custody and counterparty risk. So, the idea sounds simple, metal money. But the implementation is messy. And that's why I don't treat these headlines as the dollar is over. I treat them as the system is experimenting. And experiments create volatility. Not because they're evil, but because people react before the system stabilizes. That does not mean you're going to walk into a grocery store tomorrow and pay with a gold coin. But it does mean the conversation is moving from internet threads to actual policy. And policy matters because policy changes incentives. So here's the second question for the comments. If your state offered an opt-in system where you could settle certain payments using metal-backed credits, would you use it or would you rather keep everything in dollars? Now, let's zoom back out because the market move is still the core of this. Silver went down hard, gold went down, Bitcoin went down, and people are acting like that proves everything is broken. But correlation in a fast sell-off is not proof of a single conspiracy. Sometimes it's just the same crowd unwinding at the same time. In other words, if the same institutions and funds hold multiple assets and they get a margin call, they sell what they can sell, not what they want to sell. So, you get the weird side of safe assets and risk assets dropping together. It's not a philosophy statement, it's a plumbing problem. Now, one guest analyst I listened to made a point I actually agree with. Pullbacks are where disciplined people do their best work. But I want to say it my way because the internet turns that into a slogan and then people lose their brains. The goal isn't buy every dip. The goal is build a plan that survives dips. And the simplest plan for a normal person is not fancy charts and not hero trades. It's position sizing, time, and patience. If you're stacking physical metal for the long haul, a pullback is not an emergency. It's a sale, yes, but only if you were already planning to buy. If you weren't planning to buy, it's just noise. Now, here's the part that might surprise you. Volatility can actually shrink after a violent move. Because once a big chunk of leverage positions are gone, the market can breathe again. That's why you can see a huge candle on the chart, and then a few days later, the expected move bands start tightening. It's like shaking a soda can, popping the tab, and then the fizz calms down. The chaos was real, but it doesn't necessarily last forever. Now, does that mean silver is done dropping? No. And this is where I'm going to push back on a popular narrative. People love to throw out precise targets like they're reading your future. They'll say it has to go to this number like the market owes them a map. The market doesn't owe you anything. A more honest way to think about it is ranges. Silver has been living in a wide range for a while. And when you're in a range, the market is basically a rubber band. It snaps toward the edges, it scares people, and then it snaps back. And if you've never traded ranges before, it feels like the end of the world every time it stretches. So instead of obsessing over one magic price, I want you thinking in zones. Where did buyers show up last time? Where did the market leave a gap? Where did momentum flip? Those are zones, not certainties, zones. Now, if we do get another leg down, there are two completely different kinds of people watching that. There's the trader who wants a quick bounce, and there's the long-term buyer who wants to accumulate. And those two people should not be using the same playbook. A trader cares about the next week. A long-term buyer cares about the next decade. So, if you're a long-term buyer, here's the discipline. You don't try to nail the bottom, you scale. You buy a little, you wait. You buy a little, you wait. And you only increase size when the market gives you confirmation, not when your feelings demand it. Now, I know somebody is thinking, okay, but what about my retirement account? Do I even own what I think I own? This is where the conversation gets spicy, and I'm going to keep it grounded. There is a legitimate point buried inside the hot takes. Custody matters. If an asset is held through an intermediary, you have counterparty risk. That's real. But there's also a trap. People hear counterparty risk, and they translate it to you own nothing. That's not automatically true. There are legal frameworks, account structures, segregation rules, and protections that vary depending on what you're holding and where it's held. So the honest truth is, sometimes you have strong rights, and sometimes you have weaker rights, and most people don't know the difference. And that's the real problem. Not that everyone is doomed. The problem is that most people never read the fine print until the day the fine print matters. So here's what I want you to do, and you can do this after the video. Pull up your statement, look for the words custodian, beneficial owner, and segregated. If you don't understand what those mean, that's your homework. Because whether you buy physical metal or not, understanding custody is part of being an adult investor. Now, let's talk about the government shutdown chatter, because that's another ingredient people are mixing into the soup. Right now, the immediate issue isn't the entire government disappears. The immediate issue is a funding deadline tied to the Department of Homeland Security and a Senate vote that failed to clear the bar, raising the odds of a lapse starting Saturday, February 14th. So that part is real. It's on the calendar, it's in the headlines, but the market impact is not automatic. Sometimes shutdown drama is already priced in, sometimes it's not. Sometimes it becomes a bigger confidence story because it stacks on top of everything else people are already anxious about. And that brings us to the uncertainty part. Because beyond prices, beyond rumors, beyond shutdowns, the bigger theme of this whole moment is uncertainty. And we can actually measure that. There are public indices that track how often the word uncertainty shows up in policy and economic reports worldwide. And those indices have stayed elevated compared to the calm years before the pandemic era. That doesn't tell you where silver goes tomorrow, but it does tell you something about the environment. In a high uncertainty environment, narratives move faster than facts. People jump from headline to headline, and markets don't like that because markets are pricing machines. They want probabilities, not thousands of people across different countries, different languages, different beliefs cooperate without ever meeting each other because the price system coordinates them. And when the price system is allowed to work, it creates cooperation. But when you distort the price system through controls, through bad incentives, through policy uncertainty, you get friction, you get shortages, you get black markets, you get mistrust. And I'm bringing that up for one reason. It explains why physical markets and paper markets can diverge. When the paper market is dominated by leverage and speed, it can overshoot. When the physical market is dominated by inventory and logistics, it can lag. And the gap between them is where people either panic or get educated. So what do you do with all this? First, you don't let a dramatic day trick you into a dramatic identity. One day doesn't make you a genius. One day doesn't make you a victim. Second, you decide what game you're playing. If you're trading, you need risk controls that assume you can be wrong. If you're investing long term, you need a plan that assumes prices will swing. And if you're stacking physical metal, you need to shop around because premiums can change faster than spot. Now, I also want to address the idea that the best time to buy is when it drops. That is sometimes true, but it's incomplete. The better sentence is the best time to buy is when your plan tells you to buy, because a drop without a plan is just a drop. A drop with a plan is an opportunity. And here's the retention kicker. Most people don't blow up because they're wrong about direction. They blow up because they're wrong about size. They go too big at the wrong moment. They buy the top because of excitement. They sell the bottom because of fear, and they call it strategy. So if you want to be the person who survives this and wins long term, focus on behavior, not predictions. Small bites, repeatable actions, long time horizon. Now I want to pause and say something to the people who are already doing it right. If you're successful, share your success story in the comments so others can stay motivated, because that's the part nobody sees. People see the outcome, they don't see the habits. Now back to the rumors for a second, because I know someone will say, okay, but what if Fort Knox really is empty? If that extreme scenario were true, you wouldn't want to be making rush decisions based on a tweet or a screenshot anyway. You'd want documentation. You'd want process. You'd want verification. And the fact that lawmakers are pushing audit proposals tells you the pressure is there. But it also tells you the system moves slowly. So if your plan depends on a sudden overnight revelation, that's not a plan. That's a lottery ticket. And lottery tickets are fun, but they're not a retirement strategy. Now let me loop back to silver, because that's what brought everybody here. We've seen sell-offs like this before in other markets. Sometimes they turn into longer bear phases. Sometimes they become the exact shakeout that sets up the next leg higher. The difference is not the chart pattern. The difference is the macro backdrop. And right now, the macro backdrop is a two-golf war. On one side, you have sticky costs, high debt loads, and political dysfunction that keeps risk elevated. On the other side, you have cycles. You have mean reversion. You have policy shifts that can flip sentiment fast. So if you're looking for a single clean story, you're going to be disappointed. This is a messy story, but messy doesn't mean uninvestable. Messy just means you need rules. So here are mine, and you can borrow them if you want. 1. Never make a big decision on a big day. 2. If you're buying, buy in pieces. 3. Always know why you own what you own. And 4. Don't confuse internet certainty with real certainty. Now, I'll leave you with one more thing. The market didn't just randomly become more chaotic. There are structural reasons. More trading is automated than ever. Liquidity concentrates and then disappears. Options flows can amplify moves, and when a popular trade gets crowded, the unwind is violent. That's not a conspiracy. That's modern market structure. So the next time you see a chart that looks like it fell down an elevator shaft, don't immediately assume the world ended. Assume the plumbing got stressed. Then ask, is the underlying story actually changing, or is the market just clearing out the weak hands? Because your answer to that question determines whether you panic or you prepare. And if you want to keep preparing with me, subscribe, stay close, and keep your eyes open. And if you want, hit like, so this reaches people who need calm today. I'll see you in the next video. And as always, this is for education and entertainment only. I'm sharing how I think through markets, not telling you what to buy or sell. Talk to a qualified professional who knows your situation before making any financial decisions.